Okay, well, let's kickstart the Money Show then and introduce our very first guest, Harshad Chetanwala, the co-founder of mywealthgrowth.com. Harshad, thanks so much for joining us today on the Money Show. It's a pleasure having you with us. Let's start off first by talking about this rally that we have seen in the markets. It's at record high levels. What should existing mutual fund investors do right now? What should their MF strategy be? How can they sort of view this markets? Because the temptation will be that, okay, you know what, I'm sitting on great wealth, the markets has gone up too much. So the temptation could be that maybe I can book some profits. On the other hand, of course, which could also be wrong, you keep getting into this greed mode where you think that, okay, you know what, let me just keep holding on and the market will go even higher, which can also be detrimental. So what should be an ideal MF strategy?
Thank you, Mubina. It's a very interesting question. It's like a hot topic right now because markets are at all-time peak at around 58,000 odd, and everyone would like to do some sort of profit booking. In our view, there are two ways to look at it. So one is there are those investors who have been investing for a very long time and sitting with these fabulous profits or the growth that we have seen in last 1.5, 2 years. At the same time, there are the other investors who would like to enter the market. So I would like to answer this in two ways, if you are fine with. So the first point is that those investors who are already invested right now, these are all long-term investments when we invest into equities, and all these investments need to be linked with some financial objective. So in case there are investors who are investing into the stock markets or already built that corpus and they are very near to their financial goals, let's say within a year or so, then this could be a very good opportunity for them to start de-risking this money because the markets are at 58,000 odd. Okay, so you'll start de-risking it by a systematic withdrawal plan. So you start withdrawing this money back into your bank account or a liquid fund. This will help them because since their financial goal is just coming in 1.5 year. Coming to the other part, where people who have their financial goals which are still beyond 3 years, 5 years, they should remain invested. If in case their investments are predominantly in large cap funds, there's one space where people may think of doing some sort of profit booking if they have their money invested in dedicated small cap funds, because these small cap funds and the small cap space had a phenomenal run in last 1.5 year or so. And if you see last 1 year, 100 rupees invested in 1 year in small cap fund would have, or small cap index would have been around 181 right now. So could be some opportunity for small cap fund investors to do some sort of profit booking. But predominantly, those investors who are right now investing into equities can continue to remain invested into equities.
All right. So basically, from the answer that you've given me, Harshad, I think what investors should do is only keep that laser sharp focus on their goals. If their goals are coming nearer, then like you said, de-risking your portfolio by way of slowly redeeming some of the equity MFs is right. Whereas if your goals are far, then keep holding on to equities. That's the approach you are recommending for those individuals who have just invested purely for wealth creation, as a way of deploying their savings into assets that can help them fight inflation, etc. Just continue holding on. Don't get carried away by what's happening in the equity markets. You have a very long-term goal, so there's much more return potential that can be made. But for those individuals who have a goal coming up, then you should slowly consider redeeming some money. Okay, what about new investors, Harshad? Because these are the guys who may think that, oh, even if I start an SIP right now, I will be getting those units at such a high level. So that may make them a little circumspect to start right now. They may think that, okay, you know what, I'm hearing a lot of market experts say that there is going to be a bit of correction, so I'll start my SIP after that correction. Is that the right approach? What would you like to recommend to first-time investors?
Sure. It's a very tricky situation for those who want to start off with their investments in mutual funds or equities in a way. Okay, I think the method of investment should be very simple. SIPs works the best irrespective of market conditions. So if in case I'm a new investor starting my journey in mutual fund, I would rather like to go through an SIP route. There could be some investors who would have some lump sum amount right now, and they would be contemplating that at this market level, should I go with lump sum? So for those kind of investors also, it makes more sense to park around 20 to 25% of the lump sum in one go, even though at this market conditions, and the rest of the money can be invested in a staggered manner through SIPs. When markets are at these levels, it is important to choose the right fund, which is very important. At these market levels, we would suggest investors or the new investors to focus on index funds and large caps rather than getting into mid caps, small caps, or the themes like international funds or a sectoral fund at this stage, because they are just entering into the equity markets through the route of mutual funds. Okay. So better to go in a staggered manner right now. SIPs will always work. Do not much worry about the markets are at 58,000, because your investments are going to happen in a, as we said, staggered manner. So if in case you start investing right now, and if there is a market consolidation which happens maybe after a week or a month or a quarter, they will get that advantage because a part of their money will get invested in the subsequent months. So that investments will get averaged out. So just follow the SIP route right now. If in case you are entering, do not venture into the ambitious investment options or categories like small cap, mid cap, or sectoral funds.
Okay, so if you're starting off as a newbie, stick to the simple ones, the products that you understand. Don't get into sectoral, small cap, mid cap. Though mind you, I think still we see the most amount of inflows coming into sectoral funds only. Let's talk about mid caps and small cap funds. There is a lot of momentum being witnessed in that category in terms of flows, of course, because of the kind of returns as well these funds have given, but they tend to be a bit more volatile as well. So let's say if someone's goals are coming nearer, would you recommend trimming exposure in mid and small cap funds first and then going to the large cap funds or the index and ETFs?
Absolutely. I think if my goals are near, and let's say as we discussed earlier, 1 to 1.5 years, and if my I have reasonable amount of investments in mid and small cap, I would like to start trimming it very quickly. Even though my money is in large cap, I would like to trim it in a staggered manner. But if in case it's in small cap, I would like to do it in a much more faster rate. Okay. Because of two reasons. One is the kind of surge that small cap index have seen in last year or so. At the same time, as you correctly mentioned, they are more volatile. So if there is any nervousness in the market in subsequent quarters or months, then there is a possibility that small caps may take a bigger hit. Yeah. So for that reason, if in case you hold any mid cap or small cap fund and you are nearing your financial objective, it is better to trim it. Even though you hold your small cap funds for long-term objective, then also, as we discussed earlier, it may make sense to book some profits and probably redirect it into large cap or wait for some market opportunity if in case market gives you opportunity to park that money into when the markets see some consolidation.
So within the mutual fund universe as well, even if your goals are far away, Harshad is advising that a little bit of tactical allocation and few chops and changes are all right to do. So if you have some mid and small caps, it's all right to sort of book a little out and put it in large cap funds. Now Harshad, let's talk about individual funds. Every fund is of course different in many ways. The stock composition is different, so the return as well will be different. When you do a portfolio review, what sort of a lens would you put on when identifying the underperformers and the good or the outperformers within the entire mutual fund basket? Because of course, if I have to start redeeming funds, I would want to redeem the laggards, as we call them, first. So how would you identify that when you're doing a portfolio review? What do you look at?
So it is very important to review your portfolio. The frequency need to be set in a proper manner. You don't need to review it every month end or every 15 days or even at the end of every quarter. A good 6-month time frame is good enough to review on a regular basis. Okay. So whenever you invest, you can certainly look at few aspects of the fund. The fund is any which ways linked to your financial objective. The fund is supposed to be either in a large cap or a mid cap or a mix of space or in a flexi cap space. One way to look at it is how the fund has been doing consistently over a period of time compared to its benchmark and its peers within the category. It is not that all the funds which are at the top of the chart today will always continue to be in the top of the chart forever. Each funds will have their own cycles. Each funds may go through the cycles of being on in the first quartile, and then they may go into second quartile or third quartile sometimes. The most important thing is to check on the consistency, how they are performing when compared to its peers. And another thing to look at it is, you do not compare these funds with those peers where the funds have suddenly, there is a rise or a jump in their performance. So peers category do give you some sense, but when you enter into the fund, you enter into the fund with clear objective that there is a fund objective where the investments will continue to be in large cap or a mid cap space. If that fund continues to follow that theme of being into large cap and that discipline of being into large and mid cap, then you can continue to hold that fund even though you do a review. Yeah. When the other part of the fund comes in where they have been underperforming, it is also important to know why they are underperforming. So there have been funds which have underperformed in the last year's surging market because they probably had a bit more higher level of cash. But that could be because the objective of the fund or the way the fund has been managed throughout the years is to help, is to have cash when the markets are surging. So it's the nature of the fund. And then whenever the market correction happens, these funds are in a better position to deploy that money and generate additional return for the investors. So understand the fund objective. Every 6 months, try to do the review. Look at its peers' performance within the category. Do not just go by the underperformance of 1 quarter or 2 quarters in deciding that you should exit that fund. I think the funds which you have selected after thinking a lot of, you may like to hold it for a very long time rather than churning the portfolio every now and then.
All right, that makes sense. So far, Harshad, you've spoken about large caps, mid caps, small caps, but there are so many other categories as well of mutual funds. Would you advise venturing into any of those right now? Anything looking at the current market construct and setup that looks as a lucrative opportunity?
So I think, Mubina, one important aspect is when I say large cap, I also mean a part of it in index funds, which we believe that index funds should be a part of everyone's portfolio. At the stage at which investors are, that should define what proportion or what allocation you should have in index funds. So if in case I'm entering for the first time in mutual funds, I may like to have a higher allocation in index funds and large cap. And as I get matured over a period of time, I'll continue to invest into other categories, but I'll reduce the, index allocation over a period of time. But index funds should be there in, everyone's portfolio in our view. It can range between 25 to 15% depending on the maturity of the investor. Well, there are other funds also where investors can look at. These are flexi cap funds. Is another space where where investors can certainly consider investing in. And there are other funds categories, Mubina, very frankly, which have emerged very recently, like international funds. Okay, that space is getting more and more attention of investors. But what we believe is that this particular category of international funds is meant for investors who would like to, who have already built their India portfolio, and then they would like to diversify across geography. Okay. So international funds are good, but not for investors who are starting or who have moderate risk appetite. And that too, do not get carried away with the returns that the international funds have generated. It is better to have around 10 to 15% allocation in international funds. We do not put forward, or it's not good to invest into sectoral funds or thematic funds, irrespective of how much potential these funds do have. Okay, but these are purely meant for investors, one, who have already set their portfolio and who have some additional surplus to generate that additional return, or for those investors who have high risk.
All right, but I just have one more question before we move on to questions and queries. Very quickly, then, Harshad, if people want to look at now booking profits or redeeming their funds, what's the most ideal way you would recommend one can do so without bringing on board a lot of tax liability on themselves?
So tax liability is something that you cannot skip. Okay, we all have to pay our taxes. The way to strategize it is, one is of course to withdraw or redeem. Better follow a systematic withdrawal plan strategy where every month you start withdrawing. The advantage of this systematic withdrawal is that if you see Mubina, the markets since in this calendar year itself has given around 23% return. Market were looking at all-time peak somewhere in January or February when people were interacting. Now we are in September, the market has touched a new peak. So in such an environment where the market continues to grow, at the same time there is some sort of vulnerability, okay, where people do think that there could be some sort of market correction or a sort of a consolidation. In such an environment, it is better to do a systematic withdrawal plan where every month or at a particular periodic interval, you start withdrawing this money. And you start parking this money into bank account or liquid funds. Those investors who would like to look at the tax implication perspective, of course, all equity withdrawals or equity fund withdrawals are liable for long-term capital gains, where all the investors get that 1 lakh rupees of capital gains as tax-free. So that can be factored at the time of withdrawal.
All right. Okay, well, let's take on board our questions and queries then very quickly. First up, we have a question coming from Anurag Shukla. He says, I'm 28 years old and have 50 lakh rupees capital available. I can also save 75,000 per month from my salary. Well, kudos to Anurag on being able to amass such monies at 28. Now he's asking, how should I invest so as to amass a crore within 2 years? That would help me become financially independent. I am not risk averse. So it's a very aggressive strategy. He's already got 50 lakhs, which he wants to at least double within 2 years, plus he can save 75,000 per month from his salary. Now the question is, Harshad, that 1 crore in 2 years, it may be, even if it's let's say achievable at 30 to become is it possible at 30 to become financially independent having only 1 crore rupees?
It's a very good question. So first thing is, it's very encouraging to see Anurag, who is 28 years old and he has accumulated such a good amount of wealth for himself. Okay. Your question is absolutely relevant. Whether 1 crore is good enough to be financially independent. So of course a lot depends, Mubina, on what is the definition of financially being financially independent, because the definition is very subjective in nature. Of course, certainly 1 crore is not enough. But coming to the point that Anurag would like to build a corpus of 1 crore, okay, and we are looking at market which is at 58,000, and certainly last 1 or 2 years of market returns are not the right benchmark to evaluate and even though calculate that the amount of 50 lakhs will become 1 crore in 2 years. So just to give you a small update on that, if in case we call it an update, so that 50 lakh rupees that you have, Anurag, which you invest today, along with that 75,000 rupees every month, considering even a 12% return per annum, okay, within 2 years you may not be able to achieve that number. Okay. Somewhere you will have to increase the time period to around 3 years. Okay. 3 years looks to be more reasonable when it comes to targeting that 1 crore. But yeah, the most important question remains that probably that 1 crore is not sufficient to take care of your, to be a financially independent person. Okay. Yeah, I'm not assuming that at the age of 30 your plan is to retire. Of course, you may like to be like to use this money into some other venture or whatever you would like to do. Okay. But 1 crore is very less if in case we think from a financially independent individual perspective.
Okay, all right, understood. Well, yeah, I guess it's a little subjective as well. What exactly do you mean by financial independence? Maybe it was incorrect for me to presume that he means a retirement, early retirement. He may still be continuing to work, but I think financial independence, I'm glad that he's brought about this topic, a very important one. Okay, I think we have time for one more question. Rupa Banerjee says, I have SBI Balanced Advantage Fund, which he subscribed to in the NFO. It was a very hotly subscribed NFO. Now she wants to know what's the prospect of this fund. She also has the HDFC Balanced Advantage Fund, and now she's asking if she should subscribe to the HSBC Midcap Fund, whose NFO is going on right now. What's your take quickly, Harshad?
Here we have someone who'd like to invest into NFOs. So the first thing I would like to touch base on NFOs, and then I will probably like to quickly touch base on balanced fund and the mid-cap fund that Rupaji is talking about. Okay. So when you're planning to invest into NFOs, ideally the NFOs, if those NFOs are offering any unique proposition, then it makes sense to go for an NFO, because you do not have much information about how the fund is going to behave. Okay. If there is already an existing fund in the same space, like I think Rupaji, I think she mentioned about HSBC Midcap Growth Fund, probably, okay, where there is a new offer which is coming up. Okay. In that case, if you are looking to invest into a mid-cap fund, there are already existing mid-cap fund which will help you to decide which mid-cap fund works well for you, because you have a lot of information data about not just about their performance, how is their portfolio, how the portfolio has behaved over a longer period of time. So NFOs should be, you should look at NFOs from an investment perspective only if in case there is a unique proposition or that product is not available in the market at present. If in case your idea is to invest into mid-cap fund, okay, you can consider investing into a well-established mid-cap fund which has a track record rather than venturing into a new mid-cap fund. Okay. Now I'll come back to the question on the balanced fund. So when someone invests into a balanced fund, it is assumed that the idea behind investing in balanced fund is to take lesser risk or limited risk. So if in case you are investing into balanced fund and you plan to invest into a mid-cap fund, this appears to be a bit more extreme. I would suggest, if in case my risk appetite is low or moderate, I would rather like to invest into a large cap fund or a large and mid cap fund to begin with, because there's a transition which is happening from a balanced fund to an completely equity oriented fund. And as we discussed earlier, your mid cap funds and small cap funds do carry more risk. They have more, they are more volatile. And in rising markets, they may look very good because they may generate additional returns. But when the markets are not in favor, it can take a massive toll on our overall returns as well as capital as well. So in my view, it is better to move from your balanced fund to large cap fund and try to avoid NFOs, because there are already a lot of existing funds which are available in mid cap space and large cap space. If you would like to still go ahead with mid cap, always go with a well-established fund, because you know how the funds have behaved across market cycles, rather than going into a new fund for which you do not have much information. At the same time, you do not have a track record.
Well, I think with that, we are completely out of time. So those viewers whose questions we have not been able to take due to shortage of time, don't fret, we'll be back tomorrow to answer your questions. Harshad, thank you so much for taking our time and joining us. We're going to have to take a very short break. Be right back on The Money Show.